3 stocks that I think have a lot of long-term potential heading into December 2018. Let's get started. What's up, everybody? My name is Ala and welcome to my world of stocks. By the way, I know you guys like timestamps, so I created some for you down below in the comment section. And I do just want to say thank you for all the support. It can be really hard to compete with some of these big YouTube channels out there. So every time you guys hit the like button and leave a nice comment, it helps a small YouTube channel like mine survive and grow further. So I just want to say thank you for all that support. Also, in case you're new to the channel, this is the monthly series where I talk about 3 brand new stocks every single month. And they're not always necessarily stocks that I'm invested in, but they're stocks that I'm tracking and keeping an eye on. And the reason I do this series is because I try to give you guys a more diverse look at some random different stocks out there that might fit your portfolio better. But if you want to know what stocks I'm actually invested in, then I do have another monthly series where I cover that. And in case you want to see past episodes of either series, I created a playlist for both, and you can find those in the description or at the end of this video on clickable cards. And lastly, I'll just give that quick little warning that I'm a long-term investor. Anything can happen in the short term. I have no control over that. I have no way of predicting that. Long term for me means many decades. So if any of these stocks drop, don't blame me for it. You should always do your own research and make your own decisions. Nobody's telling you to buy anything. I'm just sharing my opinion on these 3 different stocks that I'm bullish on in the long term. All right, guys, now I've got a pretty diverse group of stocks this month. I think you're going to really enjoy it. Now, all 3 stocks are stocks that I don't think I've ever covered on the channel before. And stocks 1 and 2 are heavily impacted by the whole trade fight with China, so that might present some opportunity there. And then stocks 1 and 3 are actually pretty good dividend stocks. So we've got a wide range of stocks to look at today. Now, starting with stock number 1, that's going to be International Paper, ticker symbol IP. And they've been heavily impacted by the whole trade fight with China. It's actually one of the reasons why I've been tracking them more closely. And they also have a very nice dividend that continues to grow. And it's always nice having a dividend stock because it makes it a little bit easier to hold during times of volatility. But we'll talk about their dividend a little bit later. Now, if you've never heard of International Paper before, they have a pretty large market cap of over $18 billion, and their company description reads, IP engages in the manufacture of paper and packaging products. It operates through the following segments: industrial packaging, global cellulose fibers, and printing papers. And something that I really like about International Paper is that they operate in a market that I don't think will ever really go away. You're only going to see the world become more globalized going into the future, and there's going to be more trade between countries. And with the rise of e-commerce, you're always going to need these kind of packaging supplies, a lot of these different materials and products that International Paper sells. And don't forget that only around 12% of global retail sales are even done online. And when you look at some huge markets like China's own e-commerce market, which analysts are predicting will grow from around $1 trillion this year to as much as $1.8 trillion in 2022, less than 40% of China's population even shop online. So there's tons of room for growth in e-commerce, not just domestically, but especially internationally. And I think IP will play a major role in all of that. And even though the world might be shying away from printing paper as we become more digital, I think some of that will be offset by the fact that we continue to see recycling increase. We're always recycling paper and recycling materials, things that International Paper is heavily involved with, but we'll talk more about that in just a second. But first I want to take a look at their stock. Now, they currently trade in the $40 range, but it was just about a month ago that they fell into the 30s. So I think if you catch them in the 30s again, I think that would be a really good price. And if I'm being completely honest with you, in the 30s is where I become really bullish on the stock and where I will probably be entering it. But even if it doesn't reach those levels, their PEG, PS, and PB ratios are all either really good or at least acceptable right now. And their PE ratio is only at around 6, while the broader market is over 18 and the packaging industry itself is over 19, according to simplywallstreet.com. So this tells me that IP's valuation is not just reasonable, it's actually pretty darn attractive, especially when you consider how much fear there is right now in the markets with people screaming that there's going to be a market crash right around the corner, everybody freaking out about the trade fight with China. I think that stocks that have better valuations, smarter valuations, better prices, I think are probably going to perform a lot better. Whereas a lot of times in these situations, you see stocks, a lot of times like tech stocks or high speculative stocks that have really high PE ratios, they tend to get crushed during times of volatility. But if that's the case and IP's valuation is actually pretty reasonable, why then is the stock still down over 20% year to date and around 30% from their 52-week high? Well, it has a lot to do with the trade fight between the US and China. You see, the price of packaging materials have been climbing at a pretty fast rate. Here's a chart from Lumi.com that shows the price of corrugated paper, which is typically used for things like cardboard boxes, and you can see that in just the last few years alone, it's been climbing at a pretty fast rate. Well, guess which country uses some of the largest amounts of packaging supplies? China. After all, they're the world leader in exports by a large margin. So if China is adding tariffs to US imports, that in theory should hurt a company like International Paper. So the markets are just reacting to the fear. But is that fear justified? See, there's a major problem with this theory. China does have the capacity to make its own packaging supplies, but they rely heavily on recycled materials like paper and fiber that are imported into the country. In fact, The Motley Fool reported back in August that China relies on about 2/3 of all input material as imports that are very hard to get down the supply chain from other countries that are not the United States. Now, it's pretty hard to find concrete numbers on a lot of this data, but according to the OEC, which is an international trade observatory, in 2016, the US was the #1 largest exporter in the world of both waste paper and recovered paper that are used for recycling into new products. And they're not just the leader, but they're the leader by a very wide margin at around 30 to 40% market share, whereas the next closest country is the United Kingdom at less than 10%. And if it wasn't enough, when looking at importers of the same materials, China is at around 50%, whereas the next closest importer is Germany at less than 10%. So China is heavily reliant on something that we heavily export. That means that China is in a tough spot because if they slap tariffs on our finished products, they will have to manufacture them themselves, but they will need our raw materials that we export to them that they're heavily reliant on, that they can't really afford to slap tariffs on as well because the cost will just be passed along right back to them because they can't really afford to not purchase our exports. In other words, their economy is heavily reliant on either our packaging finished products or our materials, our recycled materials that are used for manufacturing those finished products. Now, to be fair, there is a much more reasonable concern coming from Wall Street, and that would be the tariffs on agricultural products that use International Paper's packaging supplies in order to ship them out. And there are ways that that could negatively affect IP. However, because demand and prices have been so healthy lately, we haven't really seen a negative impact on IP's top and bottom line yet. In fact, they just reported their Q3 earnings and revenue was up over 7% year over year, despite having to deal with Hurricane Florence that slowed down many of their operations in September. And earnings were even better, coming in at over 50% higher year over year and easily beating Wall Street estimates, which, by the way, looking at their last 4 quarters, they've reported positive EPS surprise in all 4 by mid to high single digits. And they even announced another share buyback of $2 billion, which is a pretty big deal considering that it equates to over 10% of their market cap. In fact, earnings were so good that the stock shot up over 10% on that earnings day alone, suggesting that so much negativity has been priced into the stock that any sign of good news is likely to lift the stock up considerably. So in conclusion, I really think that this is a stock that has been negatively impacted more so by sentiment rather than actual facts. Now, in the short term, there's a lot of things that could happen between the trade fight between the US and China. So anything can happen with IP and it could really crash at any moment, even more so than it's already dropped. So I do see some risk there, but at the same time, they're a pretty good dividend company. They're not really being negatively affected yet by a lot of this trade fight stuff. And it's being so heavily priced into their stock that there may actually be some pretty good upside to the stock. Now, I mentioned dividends, so let's take a look at that as well. They've been paying dividends since the 1980s. Their current yield is really nice at over 4%. Their 5-year growth rate is in the double digits. They have 8 consecutive years of growth, and they even have a pretty low payout ratio of less than 40%. So this is actually a pretty decent dividend growth stock as well, and I think that those dividends are pretty sustainable, and that makes it a little bit easier to hold on to this stock during these times of volatility. Now, having said that, again, it could continue to drop, and I would like to wait until the G20 summit. I'd like to see where this whole trade fight is going before jumping into a stock like IP, but I think it should definitely be on your radar because it's a pretty good dividend stock that has been beaten down quite a bit. A lot of this negativity seems to already be priced into their share price. All right, guys, now moving on to stock number 2, I think it's time that we start talking about some of these Chinese stocks that are getting absolutely destroyed, because at this point, I think they may be presenting some value to long-term investors that have a long-term mindset with a lot of these. Now, I haven't jumped into any Chinese stocks yet, except for a small speculative position in NIO, but one stock that I am really interested in is Alibaba, but I haven't jumped into Alibaba yet. I'm waiting for the G20 summit. I'd like to see where this whole trade fight is going, but in the meantime, I'm definitely keeping track of a lot of these Chinese stocks. Now, you're probably thinking that we're going to talk about Alibaba, but we've already talked about Alibaba on this channel before. I think we talked about it back in the 5 discounted stocks video. So I want to talk about something else. Let's talk about Tencent, ticker symbol TCEHY. It's a stock that a lot of people talk about, but I've never mentioned it really on my channel. Now, if when you talk about a stock that has been beaten down and getting in, we talk about buying low, selling high. Tencent has been absolutely destroyed. I mean, if you want to talk about buying low, this is definitely buying low, at least in my opinion. Now, they've really crashed into oblivion. They currently trade for around $33. Year to date, they're down over 35%. And if you look at the recent high of $61, they're down almost 50%. That is an enormous drop in price. Now, before we go any further, I just want to quickly say I'm recording this. I believe they're reporting earnings tomorrow, so I'm recording the day before earnings. But by the time this video gets out, because it usually takes me a long time to edit, and because I have a job outside of YouTube, but by the time you see this video, earnings will probably be out. So this stock might be much lower if they had really horrible earnings, or they might have had good earnings and maybe it climbed a little bit. But chances are that they might be a lot lower than what they're trading at right now. So just don't get really mad at me. Just, again, always do your own research, make your own decisions. Just keep in mind it might be a lot lower because I suck at predicting earnings, and a lot of times I make a video and then a stock has earnings and then it crashes and then I get a bunch of hate comments. So I just really hate that. So that's why I'm giving that quick little disclaimer. But with Tencent essentially being a falling knife, why would anybody try to catch it? Well, I'm going to give my long-term bull thesis on the stock, and we'll take a look at everything that they're doing and their future potential. Now, as far as the business goes, Tencent is essentially a Chinese investment holding conglomerate, that's a mouthful, meaning that they have many subsidiaries that operate in several different markets, despite mostly being an internet-based company. They're actually pretty well diversified. Now, those markets include internet services, social networking, entertainment, video, music, e-commerce, and all kinds of different technology markets, including artificial intelligence and even some cloud computing as well. And the great thing about Tencent is that they don't just operate in China, but they're really a global company in many ways. But speaking of China, they have several different platforms there, including QQ Instant Messenger, QQ.com, QQ Games, QZone for social networking, QQ Music, QQ Wallet, which offers mobile payment services, and they also have WeChat and Tenpay. And when looking at Tenpay, that's actually the second largest online payment platform in China, so that also makes Tencent a very important player in China's fast-growing e-commerce market. Not to mention that WeChat started out as a messaging app that grew to be the largest internet-based ecosystem in China with over 1 billion monthly users that even lets customers access various entertainment, set up ride shares, buy products online, and make online payments all through the app. So with over 1 billion users, Tencent has quickly become one of the biggest internet companies in China, if not the biggest. And with so many platforms, services, and entertainment, Tencent is able to bring in lots of revenue by monetizing many of those different platforms with high margin online advertisements. Not to mention that they have all kinds of different partnerships with many different major companies, including JD.com, which is the second largest online retailer in China and is often referred to as the Amazon of China. And they even have partnerships with foreign companies as well, including Google. Now, all of that sounds really great, right? So why then is the stock crashing? Well, it obviously has a lot to do with the trade fight between the US and China. Also has to do with the Chinese economy slowing down, a lot of Chinese stocks being hammered, but it also has to do with Tencent being heavily scrutinized for their gaming division being heavily regulated by the Chinese government. In fact, the Chinese government is actually banning the release of several new video games, which Tencent actually plays a major role in. We'll talk about that in just a second. But the Chinese government is doing this because they have fears of Chinese kids developing obesity problems and nearsightedness. Now, a lot of this reform being done by the Chinese government isn't really expected to be solved until sometime next year, and we don't know how it's all going to play out. So a lot of that uncertainty is being baked into Tencent's price. And to be fair, I do think that it's a pretty reasonable concern when you consider how heavily involved Tencent is with video games and especially the gaming market in China. Now, Tencent actually either owns, partially owns, or at least has partnerships with major games and or game developers and publishers that, according to Fortune.com, includes 40% ownership of Epic Games, which makes the insanely popular Fortnite that will probably bring in around $2 billion in revenue this year alone, 5% of Ubisoft, which makes games like Far Cry, Rainbow Six Siege, and Assassin's Creed, 5% in Activision Blizzard, which makes games like Call of Duty, which Tencent is also helping them bring a mobile version over to China, and they completely own Riot Games, which makes League of Legends, which is a very popular game in esports, and they also have a majority control of Supercell, which makes the very popular Clash of Clans mobile game, and they even have a partnership with Take-Two, who's behind games like NBA 2K, Red Dead Redemption, and the insanely popular Grand Theft Auto. Now, according to Newzoo.com, China is actually the biggest video game market in the world by gaming revenue, so a lot of investors are worried that all of this regulation by the Chinese government is going to hurt Tencent's revenue growth. But Tencent, to be fair, is doing everything that they can to compensate by focusing on international growth. In fact, their Arena of Valor game has over 13 million daily active users and brings in over $30 million per month outside of China. And their PUBG mobile game also has 14 million daily active users and generates over $20 million, again, also outside of China. But still, analysts feel that it may not be enough. And to be fair, just looking at smartphone game revenue, that increased almost 20% year over year in the last quarter, but it actually declined almost 20% quarter over quarter. So that tells me that these new Chinese regulations may in fact be having somewhat of an impact on Tencent gaming revenue. However, the segment that Tencent's video game revenue gets counted in is their value-added services segment, and it still saw growth year over year in the double digits at 14%, with online gaming revenues only increasing 6%, but social network revenues grew by a massive 30%. And their other two segments, being online advertising and others, both saw even larger growth, with online advertising revenue growing by almost 40% and revenue from other businesses growing by an even more massive amount at over 80% growth year over year, with total revenue still growing by 30%. So in conclusion, I think that there is a lot of different concerns that investors have, but I think a lot of it is being priced into the stock right now, representing a decent value, some potential upside. The other concerns, though, are that the trade fight, could turn into a trade war between China and the U.S., and that's a little bit of a concern. But we'll just kind of have to see what happens. At the moment, I feel like Tencent is just so well diversified that it's kind of offsetting all of these concerns, and the business seems to continue to perform well. Now, I would keep an eye on that upcoming earnings that you'll probably be able to see by the time you watch this video. So I would take a look at that if you are interested in Tencent and see how they performed and see if they slowed down or if they're actually performing pretty well. But either way, for the long term, I do think that this is a company that is very well diversified and has a lot of potential. Okay, guys, and finally we have stock number 3, and that is United Health, ticker symbol UNH, and this is a health insurance stock. We don't usually cover these on the channel basically at all, My knowledge of them is a little limited, but this is a stock that stands out to me. Now, they're currently trading for around $260 per share, and despite being above their 200-day moving average and pretty close to their 52-week high, I still don't think that they're too expensive. When you consider their forward PE is at 18, that's not too bad, and a PEG ratio of 1.3, that's pretty good, and a PS ratio of 1.1, that's also pretty good. Now, they've also had positive EPS surprise for all of their last 4 quarters, and they have a really strong income statement with net income increasing dramatically in the past 4 years, jumping from around 5.6 billion in 2014 to almost double that amount at around 10.5 billion in 2017. Now, I'm going to keep it simple with this one. This is a company that offers healthcare related services to payers, care providers, companies, employers, and even the government. This includes healthcare plans, but also pharmacy services, and believe it or not, they even work with some pretty advanced technology that they invest billions of dollars on every single year. Now, some of this is pretty basic, like mobile payments, wearable sensors, and remote medical monitoring and treatment, but they also have a data analytics segment called Optum Insight that uses things like artificial intelligence and machine learning to improve the effectiveness and efficiency of healthcare services, not to mention that UNH is even looking into blockchain technology to automate certain processes and improve the data security of healthcare information. In other words, UNH is this massive healthcare company that is also pretty darn innovative. And another reason why I like UNH is because of what's going on in the healthcare market, which is heavily affected by the country's economy and its population. You see, UNH doesn't really have high margins because a lot of their revenue has to go back to customers to cover health costs. So in 2017, their profit margin was only around 5%, but they're still able to generate so much cash flow because they benefit so much from scale, which is a result of having so many new customers signing up for health insurance products. In fact, they served 2.8 million more consumers year over year this past quarter, growing to almost 50 million people, with revenue up double digits at 12.8% and EPS up 28%, and management expects the solid performance to continue, having raised their full year guidance to adjusted EPS of $12.80, which is up from the previous range of $12.50 to $12.75. And in my opinion, there's really 2 reasons why they've seen so much really strong performance. Reason number 1 would be because of the aging baby boomer population, which, by the way, according to PRB.org, that may increase the number of Americans aged 65 and older that require nursing home care by as much as 75% in 2030 versus 2010. So the reality is that we have a very large chunk of the population that is getting older and will require more and more healthcare services. And then reason number 2 is that the economy is doing very well right now. In fact, the US GDP annual growth rate has climbed from around 1.3% in 2016 to as high as 3% this year, and unemployment rates are at the lowest that they've been in decades. So that means that more people are being employed, which means that more employers and companies are offering healthcare plans to their employees, which brings more customers over to United Healthcare. And because of all this, UNH has been able to return a lot of their profits to shareholders with over $3.65 billion in share buybacks and a 20% increase in their dividend this year. Speaking of which, their yield is a little low at only 1.3%, but their 5-year growth rate is extremely high at almost 30%. They have an entire decade of consecutive growth, and their payout ratio is less than 30%, so this dividend will likely keep increasing in the future. So with UNH, you essentially get a very massive company that is very innovative, that is seeing a rise in patients, and probably will continue to see that because of the aging baby boomer population. And you also have a pretty sustainable dividend as well. So all in all, I think UNH probably a pretty safe stock. Maybe it's a little pricey right now. It's kind of at the top right now, so maybe I would wait for a little bit of a pullback if there is one. But overall, it is a company that I like to track and one that I'm definitely interested in. Alright guys, so that's all I've got for you today. I hope that you enjoyed this video. Let me know what you think about these stocks. Do you agree? Do you disagree with anything I said? Are there any other stocks that you guys are bullish on or you guys are investing in? I'd love to hear all about it. And if you did enjoy this video, please support the channel, hit the like button. It helps so much more than you know, and it really helps the channel survive, and it makes it possible to make more videos and put those out there for you guys. So thank you so much for watching. I hope that you all have a wonderful, beautiful day. Stay safe out there in this volatile market, and I'll catch you guys later. Take care. Bye-bye.